following handout also. We'll also look at the do a multiple choice for chapter 3. And later on, I'll send out the chapter 3 exam. And extra credit points for the multiple choice. Okay, so let's go and see if we can finish this marathon of the chapter 3 handout. I'm going to add something here. You don't have to add this right now. I'm going to talk about it later. Okay. All right. So I think we're on. I don't know if the pages are right on mine. Maybe messed up because of my writing, but contingent fees. All right. Well, what are contingent fees? Contingent just means it's based on something else. So, for instance, if I'm going, if it's raining, then I'll take an umbrella. So taking an umbrella is contingent on it raining. If it's not raining, I don't take the umbrella. If it is raining, I do. So contingent fees are the same way, that something happens that will change the fee. Okay, so, whether it's, if you get this job done by June 1st, you get an extra $5,000. Okay, the extra $5,000 is contingent on us getting this job done by June 1st, whatever it is. So that's what a contingent fee is. A contingent fee is something that's based on some event or something happening. It's contingent on that fee happening. So that's what a contingent fee is. Now, in auditing, we can always charge a flat fee for anything, and they will charge fees for everything. So it isn't that you can't charge a fee. You definitely can, and they do, and they're usually pretty high. As auditors, we have this monopoly on doing financial audits, and publicly traded corporations are required to have them. So it's even better than being a lawyer or a doctor. People can't require you to go to a lawyer or require you to go to a doctor. You are required to go to a CPA firm if you're a publicly traded company. So they do make a lot of money, but the fees, they can always charge a flat fee. It's the contingent fee that that there are some rules about. Okay, so I'm going to put that right at the top here. So CPA firms can always charge a flat fee. There's nothing wrong with charging a flat fee. Now, contingent fees. There are certain situations that contingent fees cannot be so contingencies are prohibited for the following services. I'm gonna say flat fees only. So we can always charge a flat fee. So contingent fees are prohibited. Okay, first thing. Oops. Attestations or audits. So you cannot charge a contingent fee for audit. So, for example, client offers a $5,000 bonus. So client says, hey, if you give us, yeah, we'll pay you the, $10,000, but if you give us a clean audit opinion, I'll give you an extra 5,000. You can't do it. It's obvious you would not be independent by doing that. Second, so filing taxes for a client. Example. Oops. Let's try it again. 25%. So you can't file taxes for a client or amend taxes for a client for a contingent fee. Now you can always charge them a fee. You can always charge them, $300 of their taxes and like that, but you just can't charge a contingent fee. So we're talking about contingent fees here. So firm will charge 25% of the client's refund. Now, if you're not a CPA, people do this all the time. One of the weird things about the United States is that like almost anyone can perform tax services. And they can charge contingent fees. And they do. They'll say, we'll just take 20% of your refund. Whatever your refund comes out to, we'll just take 20% of that. And they do it all the time. If you're a CPA, you cannot. And the idea is obviously that, well, a couple of things. First of all, that it's incentive to file an altered tax return. And not only that, one thing people sometimes don't understand is if you take your taxes to a tax service or something like that, that doesn't mean that you're not responsible for the taxes. Whoever signs the tax return is, who's ever they're for, they're responsible for their taxes. So you could actually do something that was detrimental to your client by filing a fraudulent tax return so that you can get your higher fee. So anyway, do other people, non-CPAs, do this? Yes. It's prohibited for CPAs. The AICPA has also come out with more refined rules on this, and that some CPA firms were having people that weren't CPAs charging contingent fees. And the new rules are that any CPA and their subordinates are not allowed to do this. So you can't find somebody who's not a CPA and say, okay, we can charge contingent fees, you know, as long as it's not a CPA. Anyone who is under the direction of a CPA, that CPA is in charge of it. That CPA, it's that CPA's responsibility that they don't charge contingent fees. All right, and we're kind of closing up a loophole that. Okay. So those two are no-nos for contingent fees. Again, you can charge flat fees. Just put that right in here. Okay, last, something we have not talked about. Oh, a bunch of letters there. So I first have to tell you what a compilation is. Oops. A compilation is taking the client's data and creating financial statements. Try that again. I'll clean this up in a second. Okay, compilations are taking the client's data and creating financial statements. So you take the client's data, whatever they give you, and you make financial statements. These are generally done for clients that simply want to know kind of what their, you know, what do their finances kind of look like. They are not attestations. You don't give any assurance. It isn't like an audit where you say, you know, based on our audit, we believe these are fairly presented and all that kind of stuff. None of that. It's simply whatever data they have, you put it in their financial statements. So a compilation is kind of like, you know, let's say there's someone who runs a photography studio. They're not into accounting, you know, they run a photography studio, but they want to know kind of where they're at, you know, how am I doing? How, you know, am I doing well or bad, or what, you know, am I making money or losing money, or what's going on? So they give you all their data, and you take their data and you put it into a format, usually the financial statements form. You don't, it's their data, so you don't actually look at their data and see if it's, you don't do any checking on it or anything like that. It's simply taking whatever data they give you and you make it into financial statements and you hand them the financial statements and go, here's the financial statements. Okay, now, if they use those financial statements, if the auditor believes, if the CPA firm believes they're going to use those for either getting a loan or attracting investors, you cannot do those on a contingent fee basis. So here's what it would look like. So example. Oops. So example, the CPA firm will get a bonus of $1,000 if the compilation leads to a loan approval. So it's contingent on that loan approval. You can't do it. Why? Because it could influence you to make fraudulent financial statements so that they get the approval, so that you get the bonus of $1,000. Now, you can always charge flat fees again. So flat fees are always okay. It's contingent fees that are no-nos. So can you charge fees? Absolutely. There's just these three situations where you cannot charge a contingent fee. So contingent fees cannot be charged for these situations. Attestations, audits, basically. Filing taxes for a client. Oops. Compilations. Any questions on that? Okay, yeah, so can CPA firms charge fees? Yes. Can they always charge fees? Yes. You can always charge fees, and they do. They charge for everything. However, contingent fees, those three situations they can't, excuse me, they can't charge contingent fees on. Now, if it's not one of those three fees, those three exceptions to the contingency fee, they can. So for instance, if you're doing other work for, maybe it's not an audit client, but you're doing work for someone else, the helping them out with their inventory or whatever it is, and they say, you get this done by June 1st, we'll give you a bonus. Yeah, you can take it. As long as it's not one of those three prohibited things. You can charge contingent fees for a lot of things. It's just those three you can't. You can always charge a fee though. There is no prohibition against charging a fee. Okay, excess credible. There's a few of these, but I'll kind of hit the high ones here. Okay, yeah, how do I put this? So excess creditable. Well, I'll put the easy ones. If you're a CPA, you need to file your taxes. If you don't file your taxes, they can take your license. Two. Disclosing CPA exam questions. And also asking for CPA exam questions. Now you can ask general things like, what was tested on the CPA exam, but the actual questions themselves, you're prohibited from disclosing those. All right, and one that we're going to talk about later on. When a change in auditors, predecessor auditor, old auditor. I should say it changes. Financial inquiry. Items. Yes. Okay. And this one's kind of odd. Hey. When there's a change in auditors, the old auditor must respond to the successor auditor's inquiries, the questions the successor auditor has. Now you can still charge a fee for it, but the predecessor auditor must respond to. And the idea is that it's in the benefit of the client. Kind of weird list, isn't it? There are other ones too. Access credible. Keeping a client's. Original documents is another one. There's quite a few in here. So for instance, you get the client's documents, you're making copies of them or whatever, that's fine, but you can't keep the originals. You have to give the originals back to them. And you cannot use those to say, get your audit fee paid or something like that. We're not going to get your documents back unless you pay our bill or something like that. All right. Referral fees. For the auditing CPA firm is prohibited. Non-auditing CPA firm allowed if disclosed to the client. All right, so auditing CPA firm is prohibited. You cannot charge a referral fee, not auditing CPA firm. So if you're doing work for them that's not auditing, it's allowed, but you must tell the client. So let's say that you're doing some advisory work for a client. And the client says, I need to get, I need to get liability insurance or something. Do you know anybody? And the CPA, if the CPA firm has a arrangement with a insurance company, they can say, yeah, here, whoever it is, Stephanie's insurance company. But as long as you disclose it, say, but by the way, we get a $25 referral fee for referring you to Stephanie's. As long as you're upfront and say it. Now, that's if it's non-auditing. If it's auditing, you can't do any referral fees, because the idea is, it kind of goes back to that contingent fee things. People might be expected that they, you get these referral fees from the client that would add on to basically the audit. So if it's an auditing, if you're doing the audit for the client, you cannot charge a referral fee. If you're not doing the audit, you can, as long as it's disclosed. So you're going to disclose to the client, by the way, we get, $110 for everyone we refer to. Okay. CPA as an advisor. CPA has a fiduciary duty that's not. So CPA has a fiduciary duty to the clients and the public. These are part of the professional regulations, like doctors and lawyers. CPA cannot normally file a questionable tax return. So if they're doing a tax return, now generally the taxes are the responsibility of the client to give you the information. But the CPA firm cannot, or CPA themselves cannot knowingly file a questionable tax return on behalf of the client. They have a fiduciary duty to the public. I'll tell you, I saw a CPA for excuse me, a tax return for a business. I had a student that was planning on buying a business, and they were given the tax return for this business to kind of make their evaluation whether they wanted to buy it or not. And on the tax return, and they listed 4 full-time employees. There's the expenses for the year for employees was $11,000. Now, there's no way that full-time employees, 4 of them are going to split up $11,000. That's going to be full-time. So anyway, sometimes you'll see stuff like that is obviously very questionable. That okay, this can't be right. So if a client brings you something like that, you need to question it and get background information and see if they have the documentation. A lot of times it's like I say, it can kind of ridiculous. Okay, professional corporations. I think I'm going to do this. Yep. You need more paper here. You do that. I am back. I'm going to do this. That doesn't look much better. Sorry about this. All right. Let me focus that. All right. Partnerships. Professional organizations are generally organized around partnerships. Let's see if this one works better. Okay, so here's how a partnership works. You get two or more people together. So let's say there's partner one and there's partner two. So there's a partnership. Okay, let's say they add partner P3. So now it's partner one plus partner two plus partner three. At that point, the first partnership is dissolved. And the new partnership is there for P1, P2, P3. Okay. Partner P1 retires. All right, so now it's P2 plus P3. That partnership is dissolved. New partnership takes over. All right, so if there's just a few partners, this probably isn't that big a deal. But suppose you have hundreds or even over 1,000 partners, like some of these big CPA firms. Every week there might be someone coming in and someone leaving. You could have a partnership that was dissolved 50 times in a year. So partnerships, if they're small, it's usually okay. But if they get big, they a lot of times will have what they call a professional corporation. Oops. And a professional corporation is very similar to a partnership. Except that the partners get stock. When they leave, they give the stock back. So the corporation keeps going on forever, professional corporation, and the partners are given stock instead of dissolving the partnership every time someone comes in or somebody leaves. So that's what a professional corporation is. It's for professionals, and they're usually for large numbers. And it's to avoid this partnerships being dissolved every week. That someone comes in, they're given partnership shares of stock. When they leave, the stock goes back into the professional corporation. Okay, so that's what a professional corporation is. Okay, so professional corporations allow partners to be added or taken out of the CPA firm without dissolving the CPA firm. Under AICPA rules, all professional corporation shareholders must be CPAs. If they are associated with the AICPA. So CPA rules say that all professional corporation shareholders, so if you have a professional corporation, all of the shareholders must be CPAs. You can't have somebody who's, say a lawyer or something and doesn't have a CPA. All right, any questions on that?
Can you scroll back up for 2 seconds?
Yeah, go ahead, Garrett. Yeah, if you guys want to take a picture of that.
Oh, appreciate it.
You probably have it. Okay. Now, there are some rules when it comes to non-attest services. So these are for like non-auditing services. So, the question is, okay, let's say that you do the audit. And so these are, these are people who are getting their audit done by the CPA firm. So what else can the CPA firm do for them? So again, ooh, that's not me. Wait, does that look terrible? We gotta stop using that. All right, yeah, so this is only for those CPA firms that are doing the audits. If you're not doing the audit, there's a lot more things you can do. But if you're doing the audit, you're in kind of a special situation in that you have to be independent. And generally speaking, you can't audit your own work. So sometimes occasionally a student will say, well, I'll help the client, manage their inventory or something like that. You can't do that if you're doing the audit. If you're not doing the audit, then yeah, you can do that. But a lot of times, if you're doing the audit, you're prohibited from doing that. Okay, so this is for those CPA firms that are doing audits. And we have two sets of rules. We have the PCAOB, which is the for issuers, for big companies. PCAOB is generally only for big companies. They're companies that are publicly traded. They'll have, professional accounting departments. They'll have them, put out the financial statements actually quarterly, and then full audit once a year and all this kind of stuff. All right, so there's the PCAOB rules, and they're very strict. And then there's the AICPA rules, which are a little more lenient. And part of the reason why they're more lenient is the companies are generally smaller. You may not have a full accounting department. Maybe you have a couple people in the office that do the bookkeeping amongst their other jobs. So you got to realize that there's kind of a difference in the size of the client. So PCAOB are more, they have a lot more rules. It's not unusual. In fact, it's very common for publicly traded companies to have 2 or 3 or more CPA firms working with. It's not unusual. It's a little more unusual for the smaller non-publicly traded companies, the non-issuers. But for issuers, it's absolutely common that you have two CPA firms. And quite honestly, for many of them, they'd rather not do the audit. You know, the audit, maybe they get charged, you know, whatever, large company, maybe $3 million for the audit. If you're not doing the audit, you can charge $30 million for consulting. So it isn't, you know, the audit is not necessarily their main focus in the CPA firm. Sometimes it's, hey, I don't want to do your audit, but I'll do the consulting, you know. And that's kind of different too. In the past, it used to be, you know, they do the audit, and the audit was kind of just to grab in to get all the very lucrative consulting stuff. But nowadays, because of the rules, it's very common, if not almost 100%, that they would have more than one CPA firm working. One CPA firm will do the audit. They're very restricted in the other stuff that they can do for the client. Then you have another CPA firm that can do those other things, the ones that are not doing the audit. Okay, so what we're going to look at now are the CPA firms that do the audit. What else can they do? And some of these are fairly stark. Most of these are going to be no for the PCAOB and yes for the AICPA. Not all of them, but a lot of them. And again, kind of what I just said. If the CPA firm is not doing the audit, then these rules do not apply. This is for the auditing clients. So audit clients only. You're not an audit client, you can do what you want. Why not do what you want? You know, do more things. Okay, bookkeeping. Sarbanes-Oxley, no. CPA firm or AICPA, yes. As long as the any of the bookkeeping entries must be approved. Must be approved by the client. Oh, I skipped over something I shouldn't have. Both the PCAOB and AICPA do not allow auditors to make management decisions. So you cannot make any management decisions. Approving journal entries is a management decision. So you can do the journal entries, but management has to approve it. The auditors cannot approve that. Okay. Financial accounting system installation. No. This was a big one. Yes. However, it must be a commercial system. For instance, QuickBooks. Appraisals and valuations, no. Yes, if they have clear criteria. I should say, if they have objective criteria. So, so what I mean by that is this. For instance, they may ask you, well, we have this stock, how much is this stock? What's the value of this stock? You know, that we have on our book, we have this, whatever, IBM stock. How much of this IBM stock, what is it worth on our books? You can have objective criteria where you say, okay, well, we'll go to the closing amount for IBM and on December 31st, you know, at the end of the year, what was the closing for IBM stock? And that's objective, is, you know, look in the Wall Street Journal or something. Find that closing, and that's objective. So if you're an AICPA, you can do that. You have objective criteria that, you know, other people can verify and all that kind of stuff. If it is not objective criteria, you know, how much is this patent for you know, filtering sand, or I don't know, whatever it is. If there's no objective criteria, then you cannot do it. Internal audit function, no. Internal audit function, yes. I'm kind of surprised that any companies actually do this, because it's so much cheaper not to have your CPA firm do it. Management or human resource recommendations. No. And here, a lot of times, no, because a lot of times those are going to be management jobs, you know, for management. They generally know. There are some cases where you can make suggestions to them of, especially on things like what to look for and who's qualified for certain positions and that sort of thing. But for the most part, especially for making management decisions, you know, they talk about recommendations, but as far as making management decisions, is definitely no. Recommendations, again, they must meet the criteria that they are only for things like qualifications. Investment services recommendations, no. Yes, but only for only for, put an add in there. Only for investment allocations, not for specific investments. So you can tell them, oh, you should get, you know, 20% in energy stocks or something like that. You cannot tell them which energy stocks to pick. So it's only for the allocations. How much should they allocate to certain, you know, investments, not the specific investments themselves. That's up to the client to figure out. Legal services, not related to auditing, no. Oddly, it's yes. And I say oddly because the ACCPA has no rules on legal services. Which is odd. You know, they got rules on everything. You know, look at this. They got rules on everything. But when it comes to legal services, they have no rules on legal services. So it's sort of yes, but it's sort of yes by default. You know, no one's telling them not to do it. Now, you still can't make management decisions and all that kind of stuff, but there actually are no, the AICPA doesn't have any rules on it. Common tax, tax planning for common tax issues, this is yes. And yes. So common tax issues, there's no problem with, again, you know, planning for things that are not disputed. Planning for unusual or aggressive tax issues, no and no. Individual tax services for officers, no. This used to be very common. And yes. Oops. By the way, this planning unusual aggressive tax issues. I think I talked about this before. The auditing CPA cannot be an advocate for the client. You cannot be a rooter for the client. You cannot, you know, in a lot of ways, you can't try to help them. Because at that point, you're no longer independent. That's another weird thing about auditing. Financial statement auditing, that you can, you know, most most businesses, it's all, you know, if you have clients, it's all about helping your client. The way you help your client, if you're an auditor, is by being independent. You cannot be an advocate for the client. And if they have unusual or aggressive tax issues, you might be called in to help the client with that, you know, when they face the IRS. You cannot be an advocate for the client. You cannot take those types of things. If it's common tax issues, things that are on the books and everybody knows, that's fine. But if they have unusual tax issues, then you can't. And by the way, down here, the individual tax services for auditors, this used to be very common that when they do the audit, that they would do the tax returns for all of the you know, senior management and board of directors and all that kind of stuff. They can't do that anymore for publicly traded companies. Privately held, yep, they can do it. Very common to do it. All right, any questions on that? Oh boy, okay. I am going to briefly go over the international standards, and the reason I'm briefly going to go over the international standards is for kind of what's going on in the world, basically for the international standards. The international standards are having a really hard time with independence. They have more lax rules, which we'll talk about in a second here for it. And they've run into several instances lately that kind of undermine that there were CPA firms that were not generally what we consider independent, and there's been some bad things in auditing things that have come out because of it. And part of it is because they are very lax. For instance, they only look for if you own an immaterial amount of stock in the client, they don't consider that a problem. AICPA, if you own one share of stock in the client, you're not independent. Can't have any. You know, we don't care about materiality. Where international standards are, if it's immaterial, you don't have to worry about it. And they're also they're a little more lax in their independence in that they say, well, if there's other things involved that can mitigate it, that's okay. They don't really get into specifics about what mitigating it is. So even if somebody has an investment that is possibly material, like a close family member, something like that, they say, well, as long as there is something they're mitigating. So it gives an awful lot of flexibility to the auditors. And of course, there are always going to be those that push it, right? Well, can we do this? Doesn't say we can't do this, that sort of thing. So actually, I'm not going to cover it. I'll leave it on there. If you have any questions about it, you can read through it and kind of see, but it's there are a number of differences, and it's generally that they allow an awful lot more to go by. What they will say in regards to US standards is US standards are cut and dry, that there is no, oh gee, we found this problem with independence, can we fix it? US standards are no, you can't fix it. If there was a problem with the independence, then the audit's no good. Whereas international standards are like, well, maybe we can get away with it if we didn't say get away with it. Maybe we can help correct it or whatever if we do this, that, and the other thing. And they don't really go into explanations of what that is. It's left up to the auditors as far as what can be those mitigating factors. So anyway, you can read through that a little bit. It kind of gives you the rules on it. But there is a real problem nowadays with those standards. There's many groups that are saying, look, these audits are out of control because there's so many of them that are, the CPA firms are not independent, and that there's obviously lapses in the reporting. Okay, well, I'm gonna stop sharing here. Okay, I'm going to declare this chapter 3 handout done. We can skip these last ones. If you want to know what they are, you want to email me or something, like I'll definitely give them to you. But anyway, so let's say this is finished right here. And I think what I'm going to do is when we come back, I'm going to send out. Oh, I'm not going to send out. What are we doing here? Okay, I'm going to send out the multiple choice questions. I think we'll do the multiple choice questions before we get to the classical sampling. So we're gonna I'm gonna reverse the order a little bit and change it. We'll do the multiple choice questions second. I'll send those out, and we come back from break. We can go over those. So once you take your break, come back, and I should have those sent out to you. It'll be like a minute or two. Okay. See, I'll let you watch me do it. How about that? Sure, I picked the right ones here. Okay, hopefully you get those shortly. I'll put it up on my screen and we'll say be back at 7:14. And I'll put out the poll. So if you want to start working on it, you can. Okay, so the poll's there. I think there's 10 questions on this one. Let's take a look. Yep, 10 questions. So there aren't going to be any E or they're only A, B, C, or D. There's no E, or there's no question. So everything is gonna be A, B, C, or D for these 10.
Professor, where is it located?
The multiple choice questions, they should be in your email. Hopefully, let me see if they came yet. Oh, no, they haven't shown up yet.
Oh, there you go. Thank you so much.
Oh, you got them? I didn't get them. Yeah, yeah, they should come in the email.
Okay, thank you.
enter your answers obviously in the 10 multiple choice and I think I told you guys about this before, but don't worry about it. If you're not sure on one, you know, when I release the answers, people can't see who answered what. So don't worry about the, you know, so people may not like you because you got one wrong or All right, if you're done with the multiple choice questions, I think I'm gonna give the rest of these classical sampling ones for homework. I'll put this up again later. I'm gonna take it down in a second here. I'll put it up later, but so if you want to work on the 4 and 5, you can. And now I'm going to go over number 6 on here, which is just we've already talked about it, but we'll go over number 6 together after the multiple choice questions. But if you want to try to see if you can do 4 and 5. Oh, does this one work? Ah. So this is number 4. No, it's not. It's number 3. Lying. Is anyone still working on the multiple choice questions?
I'm not.
Anyone? Okay, I'm gonna close them up here in a second. If you are still working on them, send me a. You can do a private chat if you want, or just say I'm still working on it. Okay, I'm gonna end it. All right. So, and just to let you know, these are pretty nitpicky. This way ethics are. And even though we spent a lot of time on that chapter, you got to realize that that's something like 15 to 20% of the auditing section of the CPA exam. It's huge. So even though I don't know, it felt like we were slogging through it for years. Excuse me, that is it's an absolutely huge part of the auditing CPA I mean, and even the CPA exam in general, I mean, it's just an enormous, they have one chapter that pretty much covers 20% of the section. You're lucky if a class covers 20% of the section. Okay. Number one, you guys got it right. Yay. Yeah, materiality is not a factor. The child is considered the same as the covered member. And if they even have one share of stock, doesn't matter whether it's material or not. International standards, this would not be out. No problem. Okay. Yeah, CPA. Laws which are the following. This first one, it hangs up on this without the client's approval. They can be part of the journal entries with the client's approval, but not without the client's approval. So the B. A. D is correct. There's two I want to talk about here. Accepting a tax fee is related to an administrative proceeding. That is going to be a legal fees, whatever. As long as you are not the auditor, that's not going to be a problem anyways. C is a weird one that I wish would go away. It causes more problems than you can imagine. Financial forecasts are a real problem. You can do those as a CPA firm. You can do financial forecasts. The problem with financial forecasts are that they haven't happened. When we do audits, it's historical. What were the sales last year? What were the expenses last year? What happened last year? Forecasts go into the future, which are uncertain. So, and one of the weird things about, business in the United States is that companies are allowed and even encouraged to make financial forecasts. They're a real problem because once a company makes a financial forecast, they all know they better make it. They better meet that financial forecast. So it can cause real problems, but yeah, they do it. And it's, I wish they wouldn't, but they're allowed to do financial forecasts. The argument for them doing financial forecasts is that it gives more information for the investors. But it can also be detrimental. Okay. Yeah, good. They cannot revoke if any member CPA certificate. What's the only group that can revoke a CPA certificate? The ACCT330 is just a club. The only one that can revoke a CPA certificate is the state board. They can't admonish the member. They don't like you. All right. Which the following relations is most likely to impair CPA's independence? B is correct. A savings plan, like for instance, like at a bank or something like that, if your spouse, your husband or wife or has a savings plan at the bank, that doesn't mean that you can't audit the bank. As long as it's run of the mill, nothing special. 8, independence. It's a very weird thing, but it's the only thing that the best thing we have. Ooh, 9 is all over the place. Let's see here. Which of the following is least likely? To impair independence. Okay, they own for 2 prior years audit fees. That means you basically have an investment in the client. So this would be a no. Partner, this is close relatives. They cannot have a key financial position. The president definitely has the control over what you guys picked is correct. Overall, the D. This is a indirect interest. The mutual fund has a direct interest, but the partner has an indirect. They invest in the fund invests in the client. Like an S&P 500. And lastly, define with a covered member. Okay, so covered member, that's important. Be considered independent, immaterial, and indirect. Yes. Very good. Board of directors, if you were on the board of directors for 1 minute during the year, it's a no. The whole firm is not independent. So indirect, immaterial. Well, that's not bad. You go at 9 out of 10. So what are we at here? +4. That's not bad at all. I know as overachievers, you guys all want to have stop sharing. Download this. Give me 1 second here. I do because this is well a good thing. Extra preference. But anyway, 90% on CPA exam questions is fantastic. Passing the CPA exam is roughly 75%. You said 75% right to pass it. So 90% is woohoo. And one thing about the CPA exam is try to avoid being. If you try to be perfect, go for. You strive for. It's like Vince Lombardi. Vince Lombardi. You strive for perfection, but you're going to fail. But while pursuing perfection, you get excellence. So you're not going. You have to be able to accept a little bit that you're not going to have perfection. There's going to be CPA questions that you don't know. You have to accept that. Okay. All right. Well, let's go to. So this is problem 3. This is what you should have for problem 3 if you want to get a screenshot of it. And next week, I'll give you guys the, we'll go over 4 and 5. If you have any questions on those, we'll put the answers up and you can take a look at them. So you can do 4 and 5 on your own. So 4 and 5 are homework on the classical sampling. And I just want to go down to number 6, where we've already talked about these a little bit. when is it appropriate? The CPA exam, they have tested this, but they do it, it's actually fairly obvious. You know, which ones they're kind of aiming at, but they'll say what, you know, which type of audit of sampling is appropriate in this situation. And so that's one of the reasons why we have it on here is that, oops, got to share. You know, when is it appropriate? And we've already talked about this a little bit. Mean per unit is appropriate when that ends in the sample have a similar dollar value. So the items in the sample have a similar dollar value. I have used this type of, I have used mean per unit estimation before. When doing production, some of the production stuff for the, I work for US Steel and for Navistar, but US Steel, a lot of times they'll have, they had standard costs and all that kind of stuff. And so the items were all of similar value of groups that we had. So mean per unit was appropriate. Ratio estimation. This is appropriate when the errors in the items in the sample are proportional to the dollar value of the items. That'd be a great way of saying what I'm trying to say. Basically, it means this. Large items have large errors. So if you do have errors of it, you know, you kind of look like this. Large items have large errors, small items have small errors. And so in other words, they're proportional to the size of it. For instance, if you had $1 million account, it may not be unusual for that account to be off by $800. If you had a $10 account, it'd be very unusual to have it off by $800. You know, so it's the ratio one is proportional, and this is probably, I think, probably the one that's the most useful of the methods. This is my opinion. But most of the time, this makes sense. Large items, large errors, small items, small errors. You know, an $8 account's not going to have an $800 error. Can have that. Difference estimation is kind of the opposite of the ratio estimation. The errors, the items in the sample. Be the same. The errors in the sample will be the same regardless of So this one, they're proportional. Big things, big errors. This one, they're the same. So large. So it's when everyone will have the same error. So if you have $1 million account, it's likely to be off by $20. If you have a $10 account, it's likely to be off by $20. Doesn't matter what size it is. The difference is $20 usually. And a lot of times this will be, you know, something like some kind of handling fee or something like that that people forget to put on something. But so different estimation. I don't think I've ever used this one. I've never had a where it was appropriate. But yeah. And the CPA exam, again, they have had on their, you know, which, given this scenario, which type of sampling is appropriate, but they're usually pretty obvious which ones, you know, they lean towards. Okay, so for homework, we'll have 4 and 5. These shouldn't take you more than 5-10 minutes each. All right. All right, and I will send out the chapter 3 exam. The chapter 3 exam, I'll send that out. Excuse me. Hopefully within like the next hour or so, hopefully sooner. But it's due on the 3rd. So look for that. Oh, and it'll be emailed. It won't be on in Blackboard. It'll only be emailed. All right, any questions? Okay, well, let's call it a night, and I will see you guys next week. On the classical sampling, give 4 and 5, see if you can get through those. They shouldn't take you more than 5-10 minutes, I think, each. And then I'll send out the exam, and the exam is due a week from Friday. Is it right?
Thank you, Professor.
All right, all right. Good night, guys.
Thank you. Good night.
Thank you.